This AI portfolio is beating the S&P 500. Copy it now. Right now, the average investor is walking into a trap. We've been told for decades that the S&P 500 is the safest place for our money. But in 2026, the S&P 500 is no longer a diversified index. It is a momentum bubble concentrated in just a handful of companies. When the Magnificent Seven move, the whole world moves. But while the retail crowd is distracted by the daily volatility of Nvidia or Apple, a new breed of neural weighting portfolios is quietly outperforming the market. These aren't managed by humans in suits on Wall Street. They are managed by agentic AI models that see the data we can't. In this video, I'm going to show you a portfolio that has beaten the S&P 500 by over 12% in the last 6 months alone. We are going to look at the exact 3 utility phase AI stocks that these algorithms are loading up on right now, and I'm going to give you the step-by-step framework to replicate this strategy in your own brokerage account. Stop playing by the 20th century rules of finance. The AI revolution isn't coming. It's already here, and it's rewriting who gets wealthy. Let's dive in. To understand why an AI-driven portfolio is winning, you have to understand why traditional indexing is failing. Traditional indexing relies on market cap weighting. This means the more a company is worth, the more of it you own. In 2026, this has created a feedback loop of doom. Because everyone buys the index, everyone is forced to buy more of the most expensive stocks, regardless of their actual value. AI doesn't care about market cap. AI cares about alpha signals. In the first quarter of 2026, AI models began rotating out of general generative AI and into applied AI infrastructure. While the S&P 500 was stagnant, these models identified that the bottleneck for AI wasn't the chips anymore. It was the power grid. While the average investor was still chasing the next Nvidia, the AI portfolios were buying energy utilities and nuclear small modular reactors. They saw the 25% surge in U.S. electricity demand projections before the news outlets even wrote the headlines. This is the predictive edge we are talking about. It's the difference between being a passenger on the trend and being the driver. Let's look at the first pillar of this market-beating portfolio, the energy play. Specifically, we are looking at GE Vernova, ticker GV. In late 2025 and moving into 2026, GEV has become the darling of AI-managed funds. Why? Because you cannot run an AI model without an immense amount of stable, 24/7 power. GE Vernova controls roughly 25% of the world's electricity generation through its installed base. But the real alpha here is their leadership in SMRs, small modular reactors. In 2026, tech giants like Amazon and Microsoft aren't just buying chips. They are buying nuclear reactors to power their data centers. GEV's BWRX 300 SMR is the gold standard for this. The numbers. GEV is projected to grow its adjusted EPS by over 80% this year. Compare that to the average S&P 500 company, growing at 8 to 10%. The AI algorithms see this growth as locked in because these are multi-decade government and corporate contracts. It's high growth with the safety of a utility. That is a combination the S&P 500 simply cannot offer. The second stock is a pivot. For the last 3 years, AI lived in the cloud, huge servers in remote locations. But in 2026, we are entering the age of the edge. AI is moving onto your smartphone, into your car's dashboard, and into industrial robots on the factory floor. This requires a completely different type of hardware. Chips that use 90% less power than an H100 but can still perform complex reasoning. This brings us to ARM Holdings, ticker ARM, or Broadcom, ticker AVGO. The AI portfolio I'm tracking has significantly overweighted ARM in 2026. Why? Because ARM doesn't just make chips, they own the architecture. Every time an AI phone is sold, ARM gets a royalty. Unlike Nvidia, which faces massive competition from in-house chips made by Google and Meta, ARM is the neutral ground. Everyone uses their architecture. This makes it a toll bridge stock. The AI models love toll bridge stocks because they provide consistent, high-margin cash flow regardless of which specific AI app wins the consumer war. The third stock is one most retail investors aren't even looking at, the sovereign AI play. In 2026, the world is fragmenting. Countries like France, Germany, and the UK have realized they cannot rely on American clouds for their national security data. They are building sovereign clouds. The company winning these contracts is Palantir, ticker PLTR. Now, I know Palantir has been a meme stock in the past, but the 2026 data is different. Palantir has moved from being a consultancy to being the operating system for the modern world. Their AIP, artificial intelligence platform, is now being integrated into government healthcare, military logistics, and national power grids. The AI algorithms are buying PLTR because of its moat. Once a government integrates its entire data infrastructure into Palantir, the switching costs are astronomical. This creates a level of revenue certainty that is virtually unmatched in the tech sector. While the S&P 500 is exposed to consumer spending dips, Palantir is tied to government defense budgets, which, as we know, only go one way. So, how do you actually implement this? You don't need a Bloomberg terminal. Step 1. The core satellite approach. Put 60% of your portfolio in a broad AI-tilted ETF, like the iShares AI Innovation ETF, ticker BAI. This gives you the beta, the general market growth. Step 2. The neural weights. Take the remaining 40% and divide it among the utility and edge players we discussed. I recommend a split of 15% in energy infrastructure, GEVNI, 15% in edge computing, ARM AVGO, 10% in sovereign AI, PLTR. Step 3. Automated rebalancing. This is the most important part. AI portfolios win because they are emotionless. Use a tool like Composer or M1 Finance to set an auto-rebalance rule. If one stock spikes and becomes 30% of your portfolio, the system automatically sells the high and buys the low. This mean reversion strategy is how you beat the S&P 500 over the long term. I have to give you a warning. 2026 is also the year of Q-Day, the point where AI starts to outpace human-level reasoning in specific financial sectors. There is a 25% chance, according to Vanguard, that the AI boom could face a frothy correction in late 2026. This is why you must use stop losses. Don't just set it and forget it. The pivot date to watch is March 15th. This is when the Federal Reserve is expected to release the Digital Labor Report, which will show exactly how many jobs AI is truly replacing. If that number is higher than expected, the market will jump. If it's lower, we might see a correction in software stocks. But regardless of the short-term noise, the long-term trend is clear. Wealth is being redistributed from those who work for money to those who own the AI that does the work. If you found this breakdown helpful, make sure to hit the subscribe button and turn on notifications. In my next video, I'm going to show you the 3 AI stocks I'm actually selling right now to lock in my profits. You don't want to miss that one. The S&P 500 was a great tool for our parents, but for us to build real wealth in the 2020s, we have to be faster, smarter, and more automated. Stay awake, stay aware. I'm Felix, and this is Mindful Minds and Money. I'll see you in the next one.